Hi, class. Chapter 9. We're making progress. We're getting down to the home stretch. Current liabilities. We know about current liabilities. Let's go ahead and share the screen and take a look at the big picture. And you recall that we had our balance sheet with current assets and non-current assets, current liabilities and non-current liabilities, or long-term liabilities. Then we have our equity, common stock, additional paid-in capital, retained earnings. So what are these liabilities we're talking about? Well, some interest gets charged on, some not. Accounts payable, we usually don't charge interest. We have things that obligations and that we owe. Remember, assets are things we own, liabilities are things we owe. So if we go over to differentiate between current and non-current or long-term liabilities, similar to current assets, it's due within 1 year. In that case of assets, it's converted to cash within 1 year or used, or the operating cycle, whichever is longer. Now, we're not going to worry about the longer cycles of Boeing or of a nuclear submarine or anything that takes more than a year to build. We're going to be worried more about Apple and Belk and grocery stores, because if we waited for the milk to last for a year, we probably wouldn't be buying too much milk. So we're going to be talking about current liabilities in the 1 year time frame. And then long-term are due after 1 year or the company's operating cycle, if longer. Now, that doesn't mean if we take out a 90-day note in November 1st and it's due January 31, that means that is still a 90-day note, that's still a current liability. We're not talking about fiscal year, we're talking about 12 months worth of a year in terms of calculating and analyzing. So we look at classifying liabilities. We're going to talk about payroll as well today. So let's look at current liabilities due within a year. Company's operating cycle, long-term due after. So if we look at the chart below, you'll see that we have a Columbia Sportswear. 84% are of the characteristics, current and long-term liabilities. All America, 58%. Apple, 41%, which means 59% equity. Six Flags, 14%. Okay, so not a lot of debt to go with that. All right, so if we're looking at our liabilities, it's a big ticket potentially, and that debt to asset ratio highlights how much debt the company has taken out to acquire those assets. So let's go ahead, and we know about these, we've seen them. We have our accounts payable, makes sense. Sales tax payable. We collected the sales tax as a service to the county and the state, and we give it to the county and state, so the customer doesn't have to worry about it. Unearned revenues we know about. There's a liability because we might have to give them back. If we don't play, if the Darlington Raceway doesn't happen and the race doesn't go on, NASCAR has to refund the monies to the folks that bought tickets. Short-term notes payable, and there'll be interest often with notes payable, short or long. Payroll liabilities we'll get into, and then we get this multi-period known liability stuff that stretches over multiple years, and we have those adjusting journal entries we have to make, and they go across periods. So sales tax payable. So if we sold $6,000 in sales, and let's say we have a 5% tax rate, I know it's higher here, but that's $300 in taxes. So we collect $6,300. On the income statement, we only show $6,000. We're not going to show the $300 as revenue because that $300 is a liability, a payable, sales tax payable obligation that we need to pay. So that's the way it breaks down in a journal entry. This is a compound entry. It's got more than one credit. So anytime you have more than one credit or more than one debit, compound entry instead of a simple entry. But it's just a little more complex, but that $300 is not ours. It's not going to go on our income statement. We don't get to keep it. We eventually have to write the check for $300 and remove the payable for $300 when we pay the government entity, the county or the state, back the money that we are holding for them as a courtesy. Unearned revenues. We've talked about unearned revenues. What happens at a concert? Well, before the concert happens, we collect the cash and we have unearned revenue as a liability. It says the word revenue, but that isn't a revenue item. That's a liability item. Until we earn it, we can't move it. The concert happens on October 31 or during October, and we move a portion for that concert into actual revenue, 625, and reduce the unearned ticket revenue because we don't owe it anymore. It's been executed. It's been used. We don't have to refund that monies anymore. But if we cancel the rest of the concerts, we'd have to give back the rest of the money. So 5 million less 625 is where we would be if we were returning funds or not recording those funds. And then a short-term note payable. It's an interest-bearing note. It may arrive from an overdue accounts payable or a bank borrowing or other note borrowing from a vendor or supplier or an owner, company owner. You may be borrowing money to do that. So notice the 60-day note, 12%. And remember, we've talked about that interest rates. Is that 2 months interest rate or 12-month interest rate? Well, we better say 12 months. We said our mortgage I just refinanced a 2.75% mortgage, 15 years. That's 2.75 per year. I'd love it to be 2.75 for the life of 15 years, but it's 2.75 a year for the next 15 years. So that's why we say a car loan. Don't take one more than 3 years, by the way, if you ever get one. You're happy to talk about why later on at another time. But you take out a 3-year car loan at 4%, that's 4% a year, not 4% of the life of the loan. You take out a 20-year bond issue for 8%, that's 8% a year. You take out a 90-day note or a 60-day note, like here, that's 12% a year annual interest rates. So 2 months out of 12 is 1/6. So 1/6 out of 12, that would be 2% a month. I'm sorry, 1% a month, and over 2 months, that's 2%. So we'd have 2% on the $100. Okay. I'm sorry, 12%, not 2%. We do have cash, 600, 12%, 500 is places existing. Okay. So we're basically terming out, putting it a loan. The customer wasn't paying their payable. So we're making a note. They paid $100 down, and we termed it out to a 60-day and say, no, you're supposed to pay us in 15 days or 30 days. You're not paying it. We understand this, we got challenges. You had to close the doors during COVID. When do you think you can pay us? Oh, our doors are opening now. You can pay us in 60 days. Great. We're going to term this note out. Pay us in 60 days. Pay us interest on that note. We're not going to give you free money. So give us $100 down now, and we'll relieve the 600 payable, but we'll transfer to a 500 notes payable. And what's going to happen is eventually we're going to have $10 in interest expense, 60 out of 360. Remember, finance is 360-day year, not 365. So 60 out of 360, 2 months out of 12 months, or 1/6 times the 12%, that's 2%, times the $500 is $10. So we have $10 interest expense, we clear the note, and we write up the check for $510 when all is said and done. I may have talked fast, but you can review that if you need to. Same thing, $2,000 note, 12%. Now we have $40 in interest expense. We have to pay $20.40 when this note matures. We don't get a bill for the interest. We don't send a bill for the interest, but we know what the interest rate is based on the note we signed. If it extends over multiple periods, if, like I said, November 1st and goes to end of January, we have to expense 2 months worth of interest, November, December, at December 31st, and then get 1 month of interest expense in January, and we're going to create a payable to do that. So at the end of the period, we had created an expense and a payable. No cash changed hands. Remember, adjusting entries, never cash, and one balance sheet account and one income statement account. So in this case, our income statement account is interest expense, and our balance sheet account is interest payable. And we're estimating, and a pretty good estimate, because we know exactly how many days that was, $10 worth. So when the year, February 14th, we go around and pay that off, write the 2040 check, because it's $40 worth of interest, clear the note for $2,000, clear the interest payable from December 31 of 10, and this year, we're going to recognize $30 in interest expense. We're not going to recognize 40 in expense for this year, only 30, because 10 of it we recognized last year. Now let's talk payroll. Why do you get a nice check for $1,000 for 2 weeks of work and you deposit $600 in the bank or less? Well, there's all kinds of things associated that get deducted from your pay that the company is going to hold on to, like sales tax payable. They're going to take federal income tax and state and local income taxes and create a liability and pay those to the government. That's not revenue to the company. That's just money out of your check, net of the cash. And there might be some voluntary deductions, United Way contribution. There might be FICA taxes. There definitely will be 6.2 and 1.45% of Medicare and Social Security taxes. Pay retirement for folks that, or disability for the folks that are on it, and it's a government guarantee. There's our FICA taxes. I mentioned two interest rates, 6.2 and 1.45. By the way, if you're a sole proprietor, you have to double that. Any profits, you're going to take that 7.65, that's the combined, multiply it by 2 is 15.3, and on one of your tax forms, based on profits, you're going to pay 15.3% in taxes, just like you would have had in withholdings had you been an employee. And employee income tax, employers must pay the taxes withheld from employees, gross pay, to the appropriate government agency. So as a courtesy, the company collects it. If the IRS had to count on everybody sending in money every paycheck, and by the way, out of sight, out of mind, when you realize you paid $12,000 in taxes last year and you get a $1,000 refund, you say, great, I got a $1,000 refund. Not, oh, I paid $11,000 in taxes. So it's kind of a little bit deceptive there, but it feels good to get $1,000, but reality is you're really paying $11,000 of your money into the system. And that's why we're here. We support the system, and the system supports us. And then there are voluntary deductions, savings account, pension contributions, especially if the company's matching pension, you want to take it. If you can start saving now, even when you work part-time, if you can get on a 401k plan or an IRA, do it. But you'll be a millionaire, multi-millionaire by the time you retire, most likely. If you say, I'm going to take 5 or 10% of what I make, I'm going to pay myself first, I'm going to put it in investment accounts, it's going to compound. If you start doing that at 40 to 50, your retirement funds will be much more depleted, not there. So here's an example of a paycheck, $2,000 in expense recognized by the company. And then we've got FICA payable, Medicare's FICA payable, federal taxes payable, medical insurance payable, employee union dues payable, and salaries payable. We're going to write the check for $1,500 eventually to the employee, and these all other checks are going to go to the appropriate agencies, and we're expensing $2,000. So the time will come when down here, salaries payable and cash, on January 31, I record the expense, I accrue for it, I adjust for it, and then I write the check for $1,500, which clears the payable. And that's what the journal entries look like. I'm going to go through a $2,000 paycheck, and it's a scary scenario here. So look at our paycheck. 2,000 hours in a year, assume say 52 weeks or 40 hours, that's roughly 2,000 hours in a year. So if we do 2,000 hours in a year and you're making $20 an hour, you have 2,000, I'm sorry, let's try this again. 2,000 hours in a year. So if you have a $20,000 annual salary, divide $20,000 by 2,000 hours, dollars per hour, you get $10 an hour. In this example, we're assuming $12 an hour, $24,000 annual salary divided by 2,000 hours, it's going to be $12 an hour. So here's our $2,000 paycheck. We're going to take FICA, Medicare. We're going to take federal and state, that's a combined, FICA and Medicare, 7.65. 4% federal tax, 10% federal, 4% state. We're going to contribute, pay ourselves first. We're going to have food, rent, utilities, and hopefully you've got roommates and don't have to always eat ramen. You might have phone and internet bill. I don't understand how my daughter has a $110 phone bill for her cell phone, and I have a $22 phone bill with internet. And she has a nicer phone than me, though. I guess that's how it works. And she works part-time. That's a pretty good trick. 115 health insurance. I think get an HSA if you can, health savings account. If you're young and in good health, that's a great way to go. We won't talk much about it here, but I'm happy to talk about it another time. Yeah, you gotta wear clothes. You probably want to go on dates unless you have your significant other pay for everything. But occasionally you got to take them out anyways, even if they are. You might have a school loan to pay back. Be careful on these new cars. You just graduated. Don't say, I deserve a new car, because the insurance, the maintenance, everything's going to add up. And we're at negative 649. And you haven't even included maintenance in the car, principal insurance in the car. I have maintenance here and gas, but I don't have the principal of a loan. And I haven't taken a vacation. I try to take a vacation every 3 or 4 years, whether we need it or not. Well, now's the time to go move in your parents' house or get a roommate or conserve costs or freelance or doing this gig economy stuff or find more pay. So let's say you were able to find more pay. Let's go ahead and take what a $4,000 paycheck might look like. Okay. I still didn't include vacation here. I still didn't add much for clothes and furniture. The chances are if you're going to buy a bed for $300-400, if you're going to spend more than $50 a month in clothes, and some do, some don't, by the time you buy a pair of shoes, you're done. All right. Entertainment, you might go out on dates and do things. So now with a $4,000 paycheck, that's $48,000 annual salary, your budget says, yeah, I got a little bit of a surplus here. Although not enough to take a vacation. You might cover 2 nights in a hotel, but you don't have to eat, do you? You probably do. So be careful, and again, budget, plan. These are realistic numbers. I'm not here to scare you. I'm not saying you need to make 48,000. If you make 24, you're in trouble. I am saying you need to budget, you need to plan, and you need to think about what you're doing and how you're doing it and how you're spending things. But that's not the end of it. Not only do you as an employee have taxes withheld, the employer has payroll taxes that they match. That's 7.65% out of your paycheck. They will match it and pay another 7.65% for a total of 15.3. Do you think if they didn't have to pay that, you could get a raise? Well, probably, but Medicare and FICA and Social Security need that money too. There's also federal, state, and state unemployment taxes. FUTA, federal unemployment, and SUTA, state unemployment. So if you're laid off, you can collect paychecks for 3 to 6 months. Then the way they calculate 6% of the first 7,000 of wages, and credits given up to 5.4%. So the net rate, 0.6% on the first 7,000 is federal, and then 5.4% of the first 7,000 is state. So if you start in December, all of your wages are going to be subject to FUTA and SUTA by the employer typically. You start in January, by the time you reach 7,000, they can stop paying FUTA and SUTA, and you still get full FUTA and SUTA benefits. But it's paid for by the employer, and this is an employer expense. In addition, FICA, state and federal unemployment. This is in addition to whatever other the payroll expense itself, the $2,000. They're now paying $2,273 with this added expenses associated. Multi-period liabilities, just unearned revenues, magazine subscriptions, other things, just to be aware. We're going to have to make adjusting journal entries. Notes payable, same thing. If I go across year end or a 5-year note, we'll see bonds payable next chapter and how we account for bonds. We do some more interesting things with bonds, long-term notes like that. An estimated liability is a known obligation of an uncertain amount that can be reasonably estimated. So do you think if you were being sued for $1 million, you want to record some kind of liability or obligation? The answer is it depends. If you're Walmart, $1 million is nothing anyway, so you wouldn't worry about it. But what about if you're a small business and someone came after you and said, I'm going to sue you for $1 million. I tripped in your sidewalk. And if it's a frivolous lawsuit, chances are they're not going to get anything. So a couple of things you need to be able to do. You need to be able to make some estimates. And if it's frivolous, estimates bring it close to zero or zero. If it's a legitimate 50-50 chance or 75% chance, you're going to have to record 50% in potential expense or 75% of the settlement and expense. Other things, pension, healthcare, vacations. We need to record vacations at the end of the year as a liability. We owe our employees vacations that they haven't taken yet. And there are warranties. We have to record warranties associated with the stuff we sell at the time of the sale. There's just some employee benefits. We actually have a matching health insurance and retirement that we pay and life insurance that we pay. So those are all things that are expense to the business. Health, pension, vacation benefit expense, vacations payable. And then when employees take the vacation, we clear the payable and record the vacation. And write the check. Assume the bonus, any employee bonuses are subject to withholdings as well. And then warranty. If the seller has a warranty obligation to fix something, at the time of sale, you want to record the warranty expense and the liability, not at the time you're going to fix it a year or two from now. When Kia and The folks at Hyundai have a 10-year warranty on their transmission. Transmissions are going to go bad in those 10 years. But they have to accrue, let's say 1 out of 20 is going to go bad. So 5% of the cost of the transmission is going to be booked in the year of the sale. Just an estimate. And so this is how they record warranty liabilities. And they estimate what's going to associate with that. And finally, contingent liabilities. That was the lawsuit I started talking about. If it's possible or probable, if it's remote, frivolous lawsuit, don't worry about it. If it's possible and you can't estimate, just put it in the notes to the financial statements. If it's possible and you can't estimate, you're still going to just disclose a note. But if it's probable, that's when you make an estimate and you record the liability. But if it's probable and you can't estimate it, again, you're back to putting it in the notes. So you want to communicate to potential investors the good and the bad, and the potential or contingent liabilities that might be associated with that. And there's potential legal claims, debt guarantees. This is where Enron was doing a whole bunch of debt guarantees and was not disclosing them. And that's when they got caught, and that was when the waterfall started flowing in and they were collapsing in a big way. Other contingency, environmental damage, tax assessments, insurance losses, government investigations. State auditors come in and they catch you for sales and use tax. If you bought stuff from out of state, you didn't pay sales tax on it. Well, you're supposed to pay what's called a use tax on that stuff you bought from out of state. And if it's big enough, they will go after you to collect it. I bumped into one of those situations once before, personally. Other contingencies, environmental damages, uncertainties from future events are not contingent liabilities because they're future events. We might have a tornado or a hurricane. We might have a flood. We don't know. So that's uncertainties. We're not going to worry about that until that happens. Unless we know it's likely to happen, like we know in Florida we're going to get frost on our orchards were orange orchards, lemon orchards. So we actually plan for that in the books. We actually record that obligation because we know frost is coming, we're going to lose part of our crop. We hope to lose as little as possible. And then we've got the detail reports. These are the quarterly filings, the annual filings. Form 941 you get to file, the IRS Form 940, the employer usually quarterly, W-2 annual you get, W-4 when you get hired, payroll procedures, holding tables to go with that, and you get paychecks. So lots of payroll stuff, near and dear to all our hearts. We want to get paid. And then this is just some of the recording on tax liabilities and some of the adjustments that go with that. Not too worried about that at this stage, just to be aware. So that gives you a picture of our current liabilities, of our payroll, and how to record that kind of stuff. So I wanted to make you aware. Hope you found it interesting and enlightening, and hope it didn't scare you too much. I look forward to our next time together, and I'm going to sign off and let you be. Thank you very much.